Copying an investor isn't a shortcut, it's a delegation decision and one that you should take quite seriously. It works well when expectations are clear, but it falls apart when they're not. Copying at its core is when you allow the platform to automatically mimic the positions of another investor. In short, it is delegation with visibility. You get to see the decisions of another investor in real time, but because you have delegated it, you're not supposed to react to them. The transparency that copy trading allows, the fact that you can see another portfolio not only in real time, but every single historic position. So mine, you can see the last 10 years. When I report the performance, it is what it is. That transparency is meant to be informational. Being able to see the activity inside another investor's portfolio that you actively delegate your money or your strategy to means that it is intended to build trust, and it's not meant as something that you respond to. So let's begin by clearly stating the boundaries and defining what copying is not. Copying is not about you making day-to-day decisions. Copying is also not necessarily you agreeing to every position in the portfolio, because it's intended to be a whole strategy rather than selective position. Copying is also not about you being early or late. It's a long-term strategy, so whenever you arrive is the right time. And there is no way to compress time when it comes to copying. You can't react faster. It is that you have delegated the strategy. Somebody else is in charge. So if copying turns into a commentary, that's when it's already failed. This isn't to say that the relationship between an investor and a copier is a one-sided relationship. If anything, I enjoy some really hearty debates, thoughts, and discussions with fellow investors about markets broadly, but also individual positions in my portfolio. There are three key places when I do see copy breaking down. The first is when there is a time horizon mismatch. If you bring short patience to long-term decisions, you will be disappointed. If you confuse monthly expectation with an investor's multi-year logic, there's just bound to be conflict. The second way copy breaks down is if there's any interference. Now, this I see a lot. I often see people stopping their copy and then immediately starting again. Although I understand the logic of wanting to take out profits, it's not intended in that way. If you have to pause or resume or pick out individual positions in the portfolio or in the copy, then the system begins to be override. Those small changes over a long period of time can compound into drift. The third thing where it breaks down is emotional mirroring. When you treat visible moves as signals to react, that's when you let fear or excitement compress time and your expectation. We know that most underperformance in delegated strategies come from timing errors, not selection. Repeated studies have shown that the most expensive cost to investors by multiple percentage points in any year is their own behavior, their own interference. You are your own worst enemy by interfering, and by doing more, you end up costing yourself in returns. Let's get on to fee and the structure. Copying involves platform fees and spreads on any platform. Anywhere in the world, if you are investing in stocks, ETFs, commodities, any kind of transaction usually includes spread fees. However, there is no additional fees for copying or choosing to delegate your strategy on top of those. So whether you choose to take those positions individually and cover those spread fees, those fees are the same when you're taking those positions within a copying basket, but there's no additional fee on top of that, which is passed on to you as the copier for delegating your strategy to a pro investor. The next question then is, yes, I do get compensated by the platform when people copy me. I analyze, invest, and manage this portfolio 24/7, 365 days a year as a professional investor. There's no additional performance charge or management fee that's charged by me to you. I understand why people fixate on the cost because we have become more aware that costs in investing compound over time. The real cost here isn't actually in the fee line. The cost is the difference in your behavior under stress versus mine as a professional investor. Okay, who should actually copy another investor? Who is copying for? Copying is for people who want exposure to the stock market without having to take daily decisions or interventions. It is for people who are comfortable with drawdowns inside a predefined system, and it is for investors who can leave things alone. That means it's definitely not for short-term traders or people who want to get rich overnight. It's also not for anyone who wants to approve decisions. If you want to approve investment decisions, there are other strategies. You can get an advisory, you can buy strategies and execute them yourself. Copying isn't about needing you to approve decisions. It's actually about you automating, offloading, or delegating those individual decisions to somebody else. How does my public portfolio fit into this? My portfolio has a long-term orientation, which makes it perfect for people who are seeking rule-bound, medium risk exposure. I make small incremental adjustments, which I communicate transparently and regularly. That's why I spend all of my time deciding not only on what needs to be in the portfolio, but also what needs to not change in the portfolio. Let's be brutally honest. Copying only works when expectations are aligned. It fails, like any other relationship, when they're assumed. I hope that this video can help make things more clearer at the start for you to make an informed decision.